Hello everyone. In this presentation, we shall be discussing about the economic wealth gap explained in the free markets. Why the free markets create a wealth gap, and is it really good? Also, we shall be talking about the reasons behind the rising and continued income inequality or the wealth inequality gap and why that is actually bad. So the main points of the presentation are going to be how free markets play a role in creating the wealth gap or the income inequality gap. We shall be talking, is this really good or desirable in a free market economy? And how does the free market actually corrects this increasing income inequality or the wealth inequality gap? We shall also be talking about what are the reasons behind the continued increase in this income inequality or this rising income inequality gap. And how and what is the role of the government or the central bank in creating distortions in this economic inequality process. Before we start, we'll have a brief context of the modern monetary setup where we'll discuss how money is created and grow in the economy. Under this system, let's see how money is created in the economy. A person goes to the bank to get some loan. Now the bank takes from the person a collateral, which can be an asset, inventory, and in lieu of that, the bank grants him a loan. And voila, money is created in the economy. Because as the name suggests in this system, credit is money. Now let's see how the money flows in the system and how it benefits the risk taker. First of all, understand this, that this person A has got the money first in his hand. The bank has created the money out of thin air and given to person A. He has that money to buy an array of things first. Now using that money, he invests in a business. He starts a factory. Also using that money, he invests in some real estate, buys in some houses. Remember, the buyers right now in the economy are the risk takers, not the common people. Then he uses that money to give in to the salaries of his employees. Now comes the masses. Now comes the money in their hands. Using that money, now let's call the masses, in this case, the person B. Using that money, he buys some products from the market. He also invests the money in, let's say, first of all, real estate. However, the market has already been bought to some extent by the risk takers already, and hence the prices of real estate have risen for the masses. Also, using that money, he saves and invests in equities, which means the money in turn, some of that money in turn goes back to the factory of person A. And so he gets a further reward. So remember, getting the money first is very important and very crucial. And so in turn, getting the money first and as we'll see later on, some inflation are the rewards in the economy for a risk taker. And this is what pushes him ahead of the common masses in the economy, thus raising the gap between the rich and poor. So is this right? Is this process correct? To understand this, we should know that in a free market, labor, capital, land, material, etc., and entrepreneurship are all factors of production. And a free market based system If a business is successful, all of them would generate return, or in other words, get paid. However, the most important criteria that determine the return or reward in a free market-based system is called risk. And return based on risk with the phenomenon of compounding means that the wealth gap between the risk takers and others grow exponentially. So, apart from the input that you're bringing in vis-a-vis labor, capital, land, material, and entrepreneurship, it's also the risk that would ultimately determine your return and reward in free markets. And that is with the mathematical phenomenon of compounding would lead to the gap between you as a risk taker and the others. So yes, this is right. And this is the way free markets behave. If someone says this is wrong, unfair, etc., then only I would say is that it's like saying a tiger hunting a deer is wrong. Because this is how the nature is. And this is how the world has been moving forward and progressing. But coupled with the point above that I have just stated is the next point, which is that the phenomenon of mean reversion, or in other words, the process of creative destruction, which in free markets enable the old risk takers or winners to ultimately or later on in the business cycle lose out to newer risk takers, thus ensuring a very small chance of someone cornering almost the entire wealth or the market. It also enables this same phenomenon of creative destruction or mean reversion, also enables newer people to grow with fresh ideas. However, this is exactly where the free markets today are being hampered by the governments and the central banks, which is what is wrong. This process of socializing the losses and privatizing the the profits, thus permanently increasing the wealth gap between the risk takers, usually the asset owners, and others who are usually the owner of their own labor, completely increasing the gap in the wealth permanently, which is ever increasing, is what is wrong. This is because the rewards from the risk are being accredited to the right people who are taking the risk. Fair, like in the free markets happens. But the risk, the downside of that risk is now being shared by the entire society. People who are not willing participants in that risk. They have to share the downside. They don't get the upside. Upside is being accredited to the right people. This is incentivizing crony capitalism ultimately and disincentivizing the real risk taking. Which means ultimately in the long term, it damages the productivity growth and the society is bereft of new ideas and hence impacting the long-term growth of the economy. So let's see how and why the government or central bank intervene in the free markets. And what should be done instead to prevent future socializing of losses, or at least discourage them, and permanently increasing the gap between the rich and poor against the forces of free markets. We'll start with seeing first how the money grows in the system or in the economy. Now let's see how the money grows in the system. So the person who has taken the loan from the bank invests in his business, and his business luckily grows. Now the person sees future demand and he approaches the bank for more loan. The bank, since the business already has grown and the person has a bigger collateral to offer, the banks give him a bigger loan, and voila, more money is created in the economy. But now comes the problem in the form of inflation. How? Let's see. Now, the person has taken loan from the bank. This time he also invests in business. However, this time, because of some external circumstances or due to his own wrong decisions, the business turns out bad, a malinvestment. Or the person wrongly speculates in the real estate market. He invests money in the real estate. Or worse, he just spends it on himself. In all three scenarios, the goods or services are not created as they should have been in the economy. However, we do have credit or money supply that has already been created in the economy. So the economy has more money supply than goods and services, and due to this mismatch, inflation happens. Let's look at the second scenario. This time again, the person either invests his money in the business, which unfortunately doesn't grow. He invests the money in real estate, which, luck good for him, rises in price. This asset price rise. In both circumstances, he approaches the bank for more loan. The bank grants them a bigger loan in both cases. This, at least in the former case, is known as what we call evergreening of loan. What happens is, with this bigger loan, the person pays back to the bank the old loan, and the remaining money he uses either, let's say, for putting up his old business on road, investing again more in the real estate market, or the third scenario that we just saw, investing or spending the money on himself. In all cases, again, the required goods and services are not produced, but more credit is created in the economy, leading again to more inflation. Now, what happens to credit that was generated by the bank and was causing inflation? Now, so let's say the business or the person has failed, and even now the evergreening of loans that was happening for him has stopped. The asset market that was growing has collapsed. He has no money no longer to invest further. And in third case, anyways, he has wasted money, has spent on himself. Now a bank is asking for their loan back, but he has no money to return. Then what happens? So here's what happens when he has no money to return. The banks would take over the factory, or for that matter any asset of that person, into their custody and sell it over to a third party. So in effect, wealth is being transferred from person A to person B. During this transfer, there will be some credit destroyed in the economy, as the market value or the value at which the bank sell over the asset to the third party will not exactly be the market value. And so hence some deflationary pressures would be put on the economy, with leading to some slowdown. Let's say the second scenario. In this case, even the collateral value is insufficient for the banks to recover the loans. Then what happens? Enter the investors. They will start losing money. How? Well, because here the bank has to issue more equity, or in some cases debt also, to raise the money to cover its losses in the balance sheet. That means more credit destruction takes place, and this can lead to a bigger economic slowdown. And now the third scenario. In this scenario, even the equity value of the bank is not sufficient to cover its losses. In this case, the federal government has to step in. They have to buy equity into the banks. And how would they do that? Well, they would use the taxpayers' money to do that. They would use the taxpayers' money to buy equity into the banks. Hence, as they're shifting wealth from the taxpayers and buying equity into the bank, this will lead to a lower demand in the economy and hence a lower slowdown. Also, since they're using taxpayers' money to buy equity into the bank, it's very important that punitive actions are taken against people who are responsible for this mess. Otherwise, this phenomenon will repeat itself. And why the intervention of federal government is required? Because otherwise, we are in for a fourth scenario, which is a bigger mess. And that is, in this case, the depositors, or in other words, the common people, would lose money. This would mean the banks have to write off large amounts of loans from their balance sheets, causing enormous deflationary pressures on the economy and an eventual economic crash. So now, since the government has intervened and saved the banks and even some companies from falling apart, but what happens if instead of taking punitive actions, the government, even after its intervention, the management of those companies and banks remain the same? That's when the problem occurs. The risk takers, who must have been economically obliterated, still remain in the system to take another chance. This means it removes the opportunity and space for new participants to come in, take their places, and get a shot. That is what the actual free market creative destruction process ensures, which is now removed because of government intervention without any punitive actions. Thus, this ensures the gap between the rich and poor that was growing, and it was fine. It was part of the free market enterprise. This gap will remain in perpetuity between the same participants, by the way, and widens with very limited chance for others to come in and join. It rather becomes a more and more exclusive club. So in conclusion, getting money first and inflation, some inflation, are reasons why risk takers do better on an average and exponentially better at times in a free market setup, and this is perfectly fine. Billionaires and the wide difference in wealth between rich or risk takers and normal people is a natural outcome of free markets, and in fact is a good sign the free markets are working fine. So this ensures actually a healthy risk taking, as it will incentivize the people to join in and take some risks to get those rewards. However, like every free market phenomenon, this too has an enshrined mean reversion process ensured by the creative destruction forces of not letting the gap between the risk takers and normal people increase in perpetuity and wider, and also giving others a chance to join this, which, however, as we saw in the slides before, if interfered due to government and central banks' intervention without punitive actions, leads to a disruption of those free market forces and a permanent, ever-increasing gap between rich and the poor, which is what is really wrong. So, in case the government or central banks, as we saw in the previous slides, have to intervene for the larger objectives, which is essentially saving the economy from collapsing, it has to also ensure that punitive actions is taken against those people responsible for those crony behavior, so that in the future it disincentivizes that kind of behavior by the market participants. So thank you very much for watching the presentation. Do subscribe if you like such content and comment in case of any queries. Thanks a lot.